If this market closes anywhere near here at the end of the month, you will have massive money likely piling in. If this breaks, if you consider this broken, then this market has $8 to run. The market is seeking to take out the weak hand, and it thinks the weak hand is right above $24. I'm sorry, well, 2,400 in gold, $30 in silver. Anyway, so the market is going to find out if there's buying or selling at $30. And if it doesn't find out today, it will probably find out tomorrow.
As silver prices approached the $30 mark for the first time since 2013, the precious metals market experienced a resurgence. On Wednesday, silver futures reached their highest settlement in nearly a decade, while gold futures also rallied to a more than 3-week high. This price surge was catalyzed by the release of U.S. government data indicating a slowdown in inflation rates, fueling expectations for potential interest rate cuts later this year. On COMEX, July silver climbed 3.6% to settle at $29.73 an ounce, marking the highest finish for the most active contract since February 2013. Analysts like VinceLanci predict that if silver maintains its current price level through May, major market players may enter the fray, potentially triggering a substantial surge in demand. The prevailing sentiment in the market reflects a strong appetite for buying with little inclination towards selling, while some investors await significant price dips. Events like CPI or PPI releases often serve as catalysts for buying, particularly among those awaiting opportune moments to enter the market. Vince also anticipates increased investor interest, particularly from institutional players, which could drive silver prices higher shortly. He observes a consistent trend where every dip in gold prices is met with significant buying interest from both individual and institutional investors, including banks, funds, and central banks. These institutions have strategically positioned themselves at various price levels to capitalize on market opportunities. Over the past 2 years, central banks have emerged as significant buyers of gold. In Q1 2024, central banks' net purchases of gold reached a record 290 tons, the highest quarterly figure since 2069, marking a 69% increase over the 5-year quarterly average of 171 tons. This robust demand underscores the resilience of the gold market, suggesting that even significant geopolitical events or abrupt market sell-offs are unlikely to diminish the overall buoyancy of precious metals. We will present clips from VinceLanci's interview with Arcadia Economics, but before we do, if you want more videos like this, please hit the subscribe button and turn on the notification bell for more updates. Thank you, and enjoy the video.
Silver, I believe this was the highest close in 11 years. The reason that's important, other than the fact that it's the highest close in 11 years, we're not the only people who look at those. Managed money looks at those. That's macro discretionary money. That's the big boys. The big boys aren't really in silver yet. They're they got into gold in March. They're not in silver yet. And if this market is anywhere near this price, come May 30th, they're going to pile in. And I'll show you what you can expect if they pile in based on what they did to gold. Gold, hovering below 2,400 with no real selling, just patient buying that gets impatient periodically. Measured moves. The comment about gold focuses on the fact that I've said in several different ways, there's no real selling, there's only buying. There's no reason to short this market anymore. There's just reason to buy dips. Correlations don't matter until you want to buy. All those things mean the same thing, and that is there are a lot of people who want to buy gold with varying levels of patience. Some of them will wait for a $300 dip. They may or may not get it. Some of them will wait for a $50 dip. They may or may not get it. Some of them will wait for a $10 dip. They may or may not get it on their schedule. And so because these people are waiting, events are catalysts. CPI, PPI. They draw a line in the sand and they say, if it's not down by CPI, just get it done. Okay, so that's where we are right now. There are a bunch of people waiting for the ticket window to open for a concert. Okay, that's an analogy. I grew up with that analogy. Anyway, so the reality of that is unless there's an event, I would not expect a washout, unless there's some sort of a geopolitical event. I would not expect a washout. Every other dip is going to be bought, especially on data, because there's buying out there. And I think the banks are the buyers now as well. So the banks are buying at $20 low, okay? The funds are buying at $50 low, and the central banks are buying at $200 low. That's the way to think of the cohorts right now. So there's silver. That's a monthly chart in silver. If this market closes anywhere near here at the end of the month, you will have massive money likely piling in. Technicians talk a lot about the cup and handle. I'm not a believer in that formation. I'm not going to argue with you about it, but I'm not a believer that formation is real. It's not structured the way I would structure it, but this one is real. This is the head and shoulders. People are calling this kind of like a rounding bottom. Well, this is a head and shoulders. Shoulder, head, shoulder. Now, it may not be perfect. You have to look at volumes and whatnot. If you draw it from here, it's broken. If you draw it from there, it hasn't. If this breaks, if you consider this broken, then this market has $8 to run. Okay, so that's enough for me for starters, right? Next chart, gold, a little bit shrunken there. All right.
On Friday, gold prices showed a positive trend, driven by previous bullish momentum. This surge followed the release of softer-than-expected U.S. inflation data for April, leading markets to speculate about potential rate cuts from the Federal Reserve. However, the Fed's cautious stance on maintaining high borrowing costs for an extended period dampened optimism for rate cuts. This approach could strengthen the U.S. dollar, potentially weighing on gold prices. Analyst Vince highlighted the presence of a cup and handle formation in the gold price chart, characterized by a rounded bottom and slight consolidation resembling a cup with a handle. Traders analyzing such patterns look for confirmation signals to validate their projections. For the cup and handle formation, a breakout above the pattern's resistance level confirms the bullish bias, suggesting the possibility of continued upward movement in gold prices. Now, let's return to the interview.
Here's your monthly chart. Here's your cup and handle, which is legitimate. And here's your breakout of the cup and handle, okay? When you look at a big structure like this, you know what your target is. My target is X, my target is Y. But along the way, you're looking for signposts. You see this here? I didn't see this one. Someone else showed it to me. Actually, it was Jordan at the Daily Gold. This creates a measured move of this depth higher. Okay, this creates a measured move of this depth higher, and we got them. I saw this one. So it's kind of like these are little saucers or little cups or shot glasses if you want, right? So a move like this should get you a parallel move above it if this is a bull market. A move like this, so you add these together, you get that, and you get that. We are at the level we should be at this point in the move. Okay, so a pullback right now would not be unhealthy. Now, I don't want one, but it might not be a bad thing. Now, next chart. About a month and a half ago, someone asked me for a target. I think it was Chris at Arcadia, and or someone close to Chris. And I said, I don't really do targets, but I'll give you a level that I think we should hit. And I broadcasted it. This is a GAN fan. I'm not going to get into the details of it, except to say that I connect, if you people are familiar with it, it's a Fibonacci levels, but it's more oriented towards speed or time. So I connected the bottom of this, which is the low, and I connect a wick to wick, and I connected the December 3rd top, which was important to me, December 4th. And so I just let that go. And I've let that there for a while. And when we touched here and pulled off and then started back in here, and this is when the macro D started buying. Someone asked me where I think the market would go, and I said it should go to 2350 within 2 months. And that's what we did. So I'm not taking credit for that except to say it's a good rule of thumb. Now, this is done. And I drew another one I'm not showing you here. The other one goes further back. So these things are very fractal. And if this line hugs, okay, I have another line coming on that gets us to 20 2470 in 2 months, which is completely consistent with what's going on in the world now. So I would not be unhappy if the market pulled back here and stayed in here a little bit and then took off. Okay, so if this line hugs, even though it doesn't mean anything anymore, if this line hugs, if it oscillates around this line a little bit, then this other structure I have going back further says 2470 should happen within 2 months. Who knows? The mysteries of technical analysis.
The $30 level is set to play a crucial role in the trajectory of silver, as evidenced by its repeated testing since 2020. While there's a possibility that this level may once again repel the price, a decisive breakthrough could trigger a volatile upward surge. Such breakthroughs often lead to significant momentum shifts, potentially extending the short-term uptrend and marking a breakout from a 4-year consolidation range. Conservatively speaking, we might see silver reach approximately $32.29. Achieving these levels would represent major milestones in silver's upward journey, attracting more bullish sentiment as confidence in the uptrend grows. Share your thoughts on Vince's prediction in the comments section below. Also, make sure to like this video, subscribe to the channel, and turn on post notifications for more updates like this. See you next time.